Well, now that a lot of the dust is settled, I thought I might put an update on the REIT space. We saw a lot of brutal activity last week and even earlier in the week. And then we had 3 beautiful days, and today the REIT sector is holding up quite well, even when the S&P was down 3.5%, heading on to 4% down. The REIT space seemed to be holding up quite well, so I think the worst is over. Now we have a long road to repair. I think equity REITs will probably come back sooner and stronger than mortgage REITs. So while I'm at it, I'll break down the two. There are 2 broad types of REITs out there: equity REITs and mortgage REITs. Equity REITs own property. So let's take Northview, which I've been looking at for a while because it's trading below its takeout price. It's stabilized now. It's still running about $3 below its takeout price, but I think that given the uncertainty in the market, that's not unrealistic. At one point last week, it was $9 to $10 below its takeout price. At that point, there's no time for analysis. It's just, I'll buy whatever's there. So I was able to do quite well on that dip. So that's an equity REIT. It owns property. A mortgage REIT is something like Agency, AGNC, or Arbor, which deals primarily in mortgages. And in the mortgage REIT space, there are companies that hold agency type of mortgages and non-agency. Agency means it's backed by a government enterprise, whether it be Freddie or Fannie, but it basically implicitly has a government guarantee, and there's really only one credit tranche, which is just the AA, AAA credit tranche for that particular issue. Non-agency is not backed by the government. It typically are non-conforming loans, non-conforming for whatever reason. They simply may just be too big, or they might not have the right documentation, or the right loan-to-value ratio, whatever the case is. These are non-agency, which means they're not backed by the government. Typically, they come with credit enhancements, which credit tranching is the big one. So there'll be an A class, a B class, etc. And the A class will get paid out before the B class, etc. And then there's an equity tranche at the bottom, which usually takes all of the losses. For those, some of those companies that hold those may or may not use leverage. Leverage is pretty typical in these. So when you have non-agency mortgages in a time of what looks like a liquidity and a credit problem looming, even though this wasn't that wasn't the source of everything, along with leverage, these things get sold off fast. They get sold off fast because the market has that recency effect. The recency effect is, I remember 2007, 2008, when those lower credit tranches got wiped out, and this looks like it again, I'm out, without thinking it through. Back then, property values dropped dramatically. Here, I don't know that property values are really going to drop dramatically. So I don't know that that was such a big deal. And this week, we saw a lot of it rebound. We saw a lot of analysts follow that space, come in and change their ratings to a buy or an overweight on the mortgage REIT sector. Rates are lower. So a lot of the revenue stream for mortgage REITs is going to take a hit. It is going to take a long time, or a longer time, for the mortgage REITs to find the levels they were at before this happened. But as far as that major sell-off that we had, that big drop and this little bounce, I think that's it. I don't think we're going to revisit those lows. I don't see us revisiting 52-week highs, but I don't see us revisiting those lows. So in and around this range for some good names, I think is a good place to shop. I own some of Agency, AGNC. When it fell under 10, I took that as an opportunity to pick up some shares. I think its book value is significantly higher. Now, when you're looking at REITs, especially now, There is a few ways to look at how to value them. Book value is critical for the mortgage REITs because, well, that's basically what their book is. It's a bunch of mortgages. What can they sell them for? So that's what you'd want to look at. For equity REITs, their net asset value is what you'd probably want to pay attention to more as they report going forward than their earnings would be, because I shouldn't say earnings, but their measure of FFO or AFFO, funds from operations, and adjusted funds from operations, because those will be quite variable, but the net asset value is less variable. I think it's probably better for the next 3 or 4 quarters to tie your estimate of valuation to net asset value. And I'm pretty sure that most equity REITs right now are trading at a significant discount to their net asset value per share, which can be good or bad. You have to look at the level of debt that they have. You have to look at the type of properties they have and the mix of properties they have. And I think the less retail space, especially the less smaller mall retail space, the better it's going to be. I don't know about office space yet. I'm neutral on office space, but I'm still very bullish on apartment buildings. And I think that it probably represents a nice opportunity now to start building positions. I'm not saying spend the whole bank on these, but building positions. And listen, I can't stress this enough. You can survive almost anything in the market when it comes to investments. You can survive almost anything if you don't use leverage. If you use leverage and the market turns against you, you are going to trigger margin calls on a daily basis, which means you have to sell. If you don't use leverage, you have the luxury of holding. And especially if you're holding companies that probably will continue to pay you dividends, even though those dividends might decrease. And I do expect there to be some dividend cuts across the space. You get paid to wait and you don't trigger any margin calls. And as those dividends come in, if the prices are lower than what you bought them, there's a great opportunity to add more if the fundamentals are there. For apartment buildings, I don't see that. I don't see that going away. So that's pretty much what I see in the REIT space right now. I have seen quite a few upgrades come through for different companies, and what's I think absolutely reassuring is across a number of REITs, a lot of insider purchases have been going on. At least in the Canadian REITs that I've been following, I mentioned Arbor on my last update that there were a lot of insider purchases. No insider purchases in NVU that I've seen, but that offer is still on the table. It doesn't look like it's gone away. The price action to me looks like it's still very solid. The companies that are offering the buyout can now increase their ownership share. They were at, I think, 13%. They can go up to 19.9%. So being that the company is trading below 36 and a quarter, I don't see why they wouldn't go to their maximum position they possibly can. It's going to close sometime in the third quarter. I don't think they're in any rush to add to their position. I think they'll add in market weakness, and I think they'll be slow to add. I doubt they're going to push the price up unless they see the price moving away from them, but I don't see that happening. In the last couple of days, it's been very the volatility in the stock has gone away and it's been very flat, and it does incrementally move up, but the big jumps in price are now gone. Would I like to see it revisit the $25 and $26 price? Yeah, probably. However, I don't know that I want to go through or have my portfolio go through an event that would take it there. I think the throwing out and when there's a lot of uncertainty, people just throw stuff out, just get rid of it. They don't even think clearly. And especially if you're using leverage, you had no choice. You had no choice. You had to throw things out because you were getting margin calls all the time. And I know with Interactive Brokers, they removed intraday margin and they increased the warning that you get to. Typically it would be at 5% margin variation. You get a warning, and they moved that to 10%. so that people acted a lot faster. So I think that explains our big downturn in the REIT space and the bounce back. What gives me comfort today is, even though the S&Ps, as I said earlier, were down 3.5%, again pushing 4% down, a little over 100 points down at one point, the REIT space was holding up, and quite a few names were positive. Quite a few names that had got punished a lot were still positive. They weren't selling off as they normally did. As S&P was selling in the beginning, the REITs were selling off much faster. And as S&P bounced back, the REITs did bounce back faster, sometimes 20, 25, 30% in a day. And there were a couple of mortgage REITs yesterday that were up like 200, 300, 400%. So we know that that's a nice big bounce. There was a lot of accumulation on big volume, and that's what you want to see. You want to see it up strongly on big volume, and there was big volume in the mortgage REIT space. There's if you what just slipped my mind, the site Seeking Alpha. There are some good articles on Seeking Alpha concerning the mortgage REIT space that I've been reading over the last couple of days. Some of them good, and one of them I should have at least had it for you. If I can find it, I'll put the link in the description box. Had a listing of some mortgage REITs in the agency space that had sold off quite significantly. That if you have a 6 month to 1 year holding period, I think should do very well. I think will outperform the market on a going forward basis. So there we go. There's an update on the REIT space. On another note, I've been asked to do this kind of thing more often, and I've been very hesitant to do it, especially this last week. I've been hesitant to do it because there's just so much noise out there that I didn't want to be one more voice screaming out there, what I think. Everybody has an opinion about what they think. I don't really predict or forecast too much. I don't know where things are going to go. Are we done? I don't know. Is this going to take a long time to repair? I don't know. But again, I make decisions based on, what's the best case, what's the worst case, and if my decision would be the same both ways, then my decision is done. And I made that, that case last week, looking at apartment REITs. If the market recovers, do I want to be in apartment REITs? Sure. If the market doesn't recover, do I want to be in apartment REITs? Sure. So no matter which way the market was going to go, I didn't mind being in apartment REITs. I didn't mind being in mortgage REITs that were agency exposure as opposed to non-agency, which Arbor is mostly agency. I think it's all agency, other than their structured finance department, but in their mortgage sector, it's all agency. So I'm hesitant to say too much. I don't want to answer questions like what do I think of gold, or what's your opinion on this, or what's your opinion on that. I don't want to issue recommendations. I don't want to issue forecasts. I think that is trying to forecast where things are going, I think, is a fool's game. I think that if you make decisions that are right for you on a total portfolio basis, that meet your objectives, that match what you're looking for, and you invest wisely. And by wisely, I don't mean if you've got $10,000 in a margin account, you're going to make a $20,000 bet on silver. I think that's just a silly thing to do. You may as well go to a casino when they reopen. But there are some people who treat the market like a casino. And they're always looking for the next place to the next place to put a bet. And I'm very hesitant to talk too much sometimes about certain things, because I don't want it to sound like I am recommending certain things. If you are interested in the REIT space, I can tell you what I'm thinking and what I feel like, or what I look at. That helps you inform your decision as well. But by no means am I saying buy this, sell this, buy this, sell that. So I don't mind doing these. I'm hesitant because I don't want to get that email one day from somebody that says, I bought this because you said so and I lost money. and I had to sell. Well, first of all, that's not what I do, nor is it what I want to do, so I am hesitant. However, I do get asked questions from time to time that I don't mind answering in these kind of videos. I used to include some commentary in my CFA videos, and quite a few people liked it, but you get that every now and then you get somebody saying, look, spare me the commentary, just focus on the content, that's what I'm paying for. So I've tried to remove as much of that as possible. Some people call them rants, and maybe sometimes I do have an opinion about something and I rant a bit, but if you want me to talk about any particular topic in particular, just leave a comment underneath. Again, I really want to avoid what do you think about gold? Things like that. I really want to avoid stuff like that, because I don't want to just throw out my opinion and have people listen to it. What do you think about gold? Requires some deep thought about the role that it plays in a portfolio, the role it's going to play in the economy going forward, the value of holding it. Like, it requires a lot of thought. It's not just something that I'm going to hit a button and a baby's going to cry and I'm going to scream bye 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 and throw a pig at the screen. That's entertainment. That's I don't know that really offers you any solid advice to build on. Okay, that's it.